please welcome on stage Carlos and Ben.
Thanks, guys. Really excited to be here, and really excited to have this fireside chat with a good friend, Ben Tompkins. A little bit of background for those of you that might not know this. Ben and I met probably now 11 years ago, usually probably 10 thereabouts, around a deal that we're doing together. And I learned a lot from him at that time. And he was also one of the catalysts for Seed Camp. So when Seed Camp started off, it was an aggregation of VCs in Europe to help expedite the funding of early stage startups. And you were a big catalyst of that. But maybe with that, we can start off with a little bit of what it was like back in those times and sort of what's changed since then.
Well, I think, so, yeah, when I first started in investing, because I had a sort of career before becoming an investor, you know, London and Europe was a very different place, right? I mean, this was just about the Lehman crisis, do you remember, in 2007, which has kind of left a sort of wasteland of funding for early stage companies. And I know that, you know, Seed Camp really came about that time, and you guys really blazed a trail. I think you were one of the first 2 or 3 accelerators, incubators for tech companies in London, right? Back in, what, 2007, 2008. And at that point in time, you know, raising money was just a nightmare. I mean, raising money at the seed round, the A, the B round, it was just a desert. And I think that really pushed Europe back quite a long way, actually. So it's really great to see now that, you know, since about 2012, the market's really come alive, right? And if you're an entrepreneur fundraising for a tech business today, I honestly don't think you've had a better time than you have today. I think it's still really hard, by the way, raising money. It's always hard. But the ecosystem has just moved on such a long way. Yeah,
and what's interesting is that the role of Seed Camp back then was to help founders with the fundraising do's and don'ts. And to some extent, we still do that. It's just how we do that has changed. And one of the things that's probably worth sort of exploring is in your experience, how that's evolved. So when the very few companies that we met early days, there was one thing that I found always challenging was that the early founders of 2007, 2008, 2009 were unable to sort of articulate this idea of a bigger vision. And that vision being greater than the local economy, being a global thing, a fast-growing thing, and then inspiring capital to unlock to be able to fund that. And so part of what we did was doing that. And today, I see that less of an issue, and I see that now more. It's about creating fear of missing out within investors, generating the right metrics, and creating that lasting impression of these guys have a vision to change the world, and I want to be part of that journey.
Yeah, you know, I think as an investor, it's got harder because, in a sense, you know, a lot of what Seed Camp and Entrepreneur First and organizations like that have done is they've raised the bar massively on people's ability to present their idea. Right? I mean, we had the roasted session earlier today, and actually, it's quite hard to roast these entrepreneurs because they present quite well, you know. And going back 10 years, I don't think European entrepreneurs were as good as the Americans at getting their message across. I think that's changed. I think people, by and large, do a good job of presenting their business in a sort of an elevator pitch. So the trick now is, you know, you've got to get under the skin. You've got to figure out, you know, what really is the ambition, what really is the opportunity, you know, how is the entrepreneur, what have they figured out that's different? And that's still the hard to do bit.
And I think if I were in the audience at the moment and wondering, how do I find the fine line between overselling a vision and selling enough for an investor to feel that it's doable? How do you discern that? Because I know we're friends with founders of Revolut and TransferWise, and we've heard them pitch. And how would you distill that sort of that vision that sort of inspires confidence?
Yeah, I think inspiring confidence is something you do over a period of time. I don't think you can just show up and expect to inspire confidence in the first time you meet an investor. I think you've got to play a longer game, which is that, you know, take a 6 to 9 month period of time to raise do your fundraise, and show progression along your plan along that period of time. I think as an entrepreneur, you know, when I meet an entrepreneur, I'm not an expert in his or her business, right? They understand that business much better than I will understand it. So therefore, they should very clearly lay out to me what the milestones are that they think are the important milestones in their business, right? And then come back 2 or 3 months later and show me that you've developed those, you've hit those milestones. So kind of lay out the roadway, if you like, and show then how you achieve those milestones as you go. That's how you build confidence, right? Seeing people in action.
It's probably worth sharing with the audience kind of how we differ in terms of funds.
Yeah.
So based upon what you just said, milestones. By the way, and start getting your questions ready because we're going to open it up for questions. But as SeedCamp's concerned, those milestones that you mentioned, we're early stage, we're pre-Series A. So for me, if you want to think about what we like to de-risk, we want to have a team that is functional, that is complementary, and there's different iterations of that and what that looks like. There's an early product, but that doesn't necessarily mean that there's a market for it just yet. That's what I'm comfortable with at the pre-Series A. And how about you guys?
I totally agree. So obviously, you know, my background was at Eden. We were earlier as well. And so as you say, it's about, for me, it's about the company you keep. Is it, can the entrepreneur attract great people around them? Can they get the best advisors? Can they get the best early stage investors? Can they get the best customers? So these are all proof points that come way before revenue, right? And then as the businesses progress, I mean, we tend to spend more time looking at revenue traction, but then also what's driving that? Is it users? Is it clients, customers? Obviously, if you're a SaaS company, there's a huge amount of KPIs that people track, ARR, et cetera, MRR, how those things are growing. So I think the benefit of being a later stage investor, you have more things to track, right? Sometimes doesn't make it any easier, though, to be frank.
Yeah, higher expectations.
Yeah, exactly. I mean,
you have less excuses if it doesn't go well, right? But let's look at the transition into the actual fundraising process. Just moving away a little bit about the elements of what it takes to fundraise, and now onto the fundraising process itself, the do's and don'ts there. What are the things that you look for in hygiene? So I'm just going to go through a few things that I go for. I want to make sure that the management feels incentivized, that the key employees are incentivized, that existing shareholders aren't punitive or toxic in any way, and that basically the company is in a position that when I have to go take it to be financed, there isn't a problem with it getting financed on something structural.
So look, so the things you're talking about there is really, it's kind of, they don't talk to the product or the technology or the market. They talk to just the basic setting up of the company, right? And I think that's absolutely critical. So in a talk earlier this morning, we had Scott and Tina on the stage, and one of the questions from the audience was, well, how much equity should I give up, right? To the extent that you've given up more than 20 or 30% of your equity in a funding round is a huge red flag, because roll that out over the next 7 to 8 years of the life of the company, and assuming 4 or 5 or 3 or 4 funding rounds, you see, the founders are going to have no equity left at the end whatsoever. And so that is a massive red flag. And so I think, again, as a later stage investor, we have it slightly easier because we kind of like people like SeedCamp, who basically, when a company comes through you, we know that stuff has been done right, and that the founder hasn't given away a lot of the company. They've built a strong team around them. They've figured out how to incentivize and retain that team. And so that's something that we benefit from being slightly later stage.
And then if you move it now into curating the list of investors, one of the things that is interesting is how competitive things have been getting.
Yeah. So
not only is it about finding the right investors, making sure that you have all the attributes to be attractive to those investors, but then how to manage that fundraising process to maximize it for your benefit as a founder. And maybe you can share in your experience kind of the level of competitiveness that we're seeing these days. Well,
I think it's really good, actually. I'm pleased. So I'm obviously on the opposite end of the competitiveness because, so when I remember first starting out with Eden, it was kind of, you sat back, you said, right, I've got a checkbook, I want to write some check, tell me about your story. And you had the ability to sort of kind of sit back and let it happen and let people pitch to you. I think it's much harder now. I think that's good news, right? I mean, we talked about earlier about people like SoftBank coming into the market. Yeah. I think that's great news because it raises everyone's game. And not just the entrepreneur's game, it raises the investor's game as well. So, when we're looking at Series B rounds right now, unless we have an early relationship with the entrepreneur, if we're hearing about it when they're raising money, we're kind of one of 5 or 6 or 7 investors who are at the table at that point in time. So for us, it's even more important to develop relationships as you go. right?
Yeah.
And I think that's something entrepreneurs should be thoughtful of as well.
Yeah, and talking about relationships, I think one of the mistakes that somebody can make in fundraising is not acknowledge the nature of those relationships and start planning early about how those relationships need to be managed when you're fundraising, to the point where you might actually create animosity in your shareholder base if you don't keep them updated, communicate well. You don't want any surprises, like, for example, you don't want to throw something on your shareholders and expect them to swallow without creating a whole bunch of angry, very angry people who could block a deal. And so I've seen mistakes like that happen where a founder just poorly communicated intentions with existing shareholders of what the vision was, or recapitalization or anything like that, and that ended up in a very long time waste and legal cost waste. I don't know if you have any stories of things, fundraisers gone wrong.
Yeah, many. Yeah, this is a relationship, right? I mean, if you think about it, if you're raising money at the early stage, this is probably a 10-year journey. And if that person is going to be on your board for the next 10 years, you better figure it out early on. And I think it helps if you're on the same page on day one, because frankly, by the time you get to years 7 and 8, it's quite hard to be on the same page, right? Because time has moved on. The entrepreneur maybe wants to keep going. The VC tends to want an exit, let's say, if they've got a time horizon. And so getting the chemistry right at the beginning is really, really critical.
Yeah.
And working that relationship as well. I mean, I've had the benefit of working on for decades with lots of really good entrepreneurs, and you have to work at the relationship. It's something you can't just let it slide.
Yeah. I think one of the things, before we go into questions, one of the things that is probably worth noting is how investors think about exits, and how is that conversation breached with the founder, and how is that managed? And then, in your experience, for those of you who don't know, Ben's got an extensive background and experience in mergers and acquisitions, and you bring that to the deals that you deal with. How do you think about preparing a company to make itself acquirable or IPOable, and what can a founder do to start thinking about that early? And how do you help reconcile this sort of ideal financial outcome for an investor with maybe the ambition and vision that a founder might have?
I think you think about it really early on. That's not to say you're planning for an early exit, but I think as part of if you're an entrepreneur, as part of how you build your business, part of business development, that should be figuring out, and ultimately, for whom is my company going to be a strategic asset, right? And so whether you have the great option of going public, or whether ultimately it's going to be strategic M&A, you've got to think about that early on. And I think as the business grows, as it goes from being a technology business, technology sale, to being a company sale, and there's a big distinction between the two, and there's usually a massive gulf between those two things. You've got to think through, for whom is this a strategic asset? Selling companies is really hard, right? There tends to come a moment in time when the entrepreneur and the investor realize this is approaching the right time. But I think you can do a lot of work before that point in time to really understand what the marketplace is for the business.
So I'm conscious that we have time now for questions, and there's a really fun one here, if you don't mind me taking it first. Do you think that in terms of patterns, fundraising is similar to dating? If yes, what kind of dating strategy should we approach you? So first of all, if you're the kind of person that has a dating strategy, that might be the problem right there. But I'm going to shamelessly plug a book that I wrote about 2-3 years ago called The Fundraising Field Guide. And I do use the dating analogy quite a bit. But I think it's to what we were talking earlier about relationship building, right? Like you want to make sure that your values are aligned with the investor, that you have a good rapport with the individual partner that you're going to be dealing with for a long time. And as a consequence of that, there is one element to the dating that is kind of maybe, it sounds funny when you use the dating analogy, but basically the one thing that's going to get you a better deal is competitiveness. The more competitiveness you have as a founder between different deals, the better deal you'll have. And I don't know how you map that onto a dating strategy without sounding really shady, but I think that's probably the closest to it. Do you have any comments to add there?
I think it is a bit like dating. I'm not sure it's speed dating, to be fair. I don't think that strategy works very well. I think if you're trying to get trust from an investor, and actually the investor is trying to get trust from you, the entrepreneur, I think that just take a few iterations. And so I think, again, having a plan is a good way. I mean, for my, the next question there, which I can see, is how to set up the meeting with VC investors. Well, I actually will take most meetings, believe it or not. But where I really take meetings where people have figured out why they want to see me. So, it's fine to have a look at Draper Esprit and figure out, well, I want to approach Draper Esprit, but then you need to figure out, well, should I approach Ben Tompkins or Eleanor or Diana or Phil? And actually coming up with a very specific, well, I'm approaching you because you're invested in this company, therefore you understand the challenges I've got. You know Carlos, and Carlos is going to help me get an introduction. I mean, that's what you have to do, right? At the end of the day, there's probably only a handful of companies, a handful of investors in Europe that you really, really care about. So work those relationships quite hard, I'd say.
All right, well, we have 2 questions. I don't know which one would you rather take, Ben? Or actually, there's 3 more. But how does equity dilution work over the rounds? Or do we want to talk about ICOs? All right, raise of hands for ICOs. And raise of hands for how dilution works. All right, it looks like dilution wins.
Dilution works. So this is hilarious, right? So I think that no matter what, almost at whatever stage you're at, whether it's like the very early seed or the late DE rounds, right? I think you kind of are giving up 20% of your equity per go. And it's the one thing that doesn't really change in my estimation, because investors want to have a certain amount of skin in the game, so that the investment is so that they can see a real opportunity to return capital. And not just return a multiple of capital, but an absolute amount of money, right? I mean, so sometimes returning 10x, £500,000, if you've got a £200 million fund, that doesn't really move the needle. So the way I think about it is that you're going to give up a certain amount of equity. That's probably somewhere between 15 and 25%. In my mind, don't give up any more than that in a funding round. It's just not worth it. It doesn't scale. But be thoughtful about it. And so what then becomes the factor that moves is how much money do you raise and at what valuation. And those are the things that change. Roughly speaking, the amount of equity you give away doesn't particularly change, I don't think.
The only thing I would add to that, Ben, is I did a study as part of sort of sharing these thoughts with our founders around how dilution changes relative to the macroeconomic markets and relative to the geography companies are in. And I found this really interesting study. I forget whether it was at PitchBook data or it was, some other research body, but it mapped dilution, average dilution, based upon the year and the economic growth of the overall economy, like the S&P 500. And sure enough, like the worse the economy, the more equity investors want to take, because you need to have a return vis-a-vis with less capital, right? Because you're not going to have such a high ceiling. Whereas the better the economy is and the more competitive capital there is.
So exactly. But that's why the whole thing has changed in Europe in the last 10 years. Because going back 10 years ago, we were kind of trying to figure out how to make money on a £100 million exit or £100 million exit. That was a great exit right now. Whereas the good thing today is that we've all got much higher ambitions, right? So if it's a $1 billion exit, there's a lot more ability to make money there. So therefore, as an investor, you're less worried about having the 30%, 40%, because you know that 10% of a $1 billion exit is a great exit, right?
Yeah. And the other interesting angle to it is by geography. So in generally illiquid markets, the local investors ask for more, partially because they have less visibility on an exit the way that somebody in the Valley. And maybe this brings up the question about growth stage investors from the United States coming into Europe. How much have you seen deals being competed at the Series B level with US funds?
I think there's definitely more competition. But I don't think it's overwhelming at all. I think that there are some funds who have got a niche strategy in the US, and they bring that strategy to Europe, and I think they're very compatible and consistent in that strategy, and I think that's good. I don't worry about it that much, to be honest with you. I mean, we see people like Boulderson being very aggressive, Accel, Index, Atomico. These are the guys who we see a lot of the time. Occasionally, you see the US guys, I'd say, still.
Well, another question.
So one other thing, just to point out. So, well, just on the equity dilution question. So one thing that I just want to say as well is when you get to the B round, we actually, in the last few deals that we've done, we've given liquidity to the owners of the company, right? Because if you're an entrepreneur and if you've been on a 4 to 5 year journey to get to that B round, and you have all of your net worth in this one company, it's really hard to then ask you to then forego the existing, the current opportunity for liquidity, and then basically go for another 5 years for the billion-dollar outcome. So, in the last few deals that we've done, Ledger, Aircall, etc., we've given a bit of liquidity to the founders because we sort of said, look, if I'm asking you to believe that this is going to be $1 billion, $2 billion business, and I want you incentivized for that, why would I not let you take a bit of liquidity now?
Yeah.
And I think that's one thing that I think the Americans have always done quite well, and I think Europeans can do better. And so, and then maybe alongside that, actually put some options in as well. So effectively, the founder has a way of getting some of their ownership back up again over time. I think there's a lot of different ways of managing that dilution over the years. Yeah, fair enough. Fair enough. I guess that brings us to the next question. What are the red flags you check in every startup? So at Seed Camp, one of the interesting things that I see, because we're pre-Series A, we see a lot of early stage stuff. One of the things that I see kills companies almost 100% every time within the first year is whenever the co-founders get into co-founder disputes that are unresolved. And I found an interesting correlation between that and the maturity of the relationship between them at the start. So people who had matured how they deal with conflict management fared better than those who were put together around a business idea. Like they both might have loved the business idea, they both maybe believe in the cause, but not being able to sort of overcome those interpersonal issues and having that be a mature, stable relationship degenerated into the company falling apart. What red flags have you seen? It's a really good example. I mean, if you're investing at the Series A or Series B round, there's a good chance that one of the founders has fallen out of the boat. And how they've dealt with that, I think, is pretty critical. At the end of the day, like you, we invest in people, and we invest in people who can build a great team around them. And I think, that's and the journey is sometimes good, it's sometimes bad, right? And if you I think a lot of you take the measure of the entrepreneur of how well they do in the hard times, and how they keep their team together in the hard time. That tells you a lot. And I think maybe we'll conclude with this next question, which kind of takes it on the team, which is how to pitch an investor about a startup in a new area like AR, VR without enough market data and clear monetization. And I think it comes down back to the team. Like most of the stuff that I see where it's unclear whether or not the company has got a clear path for monetization. We invest in this company called the Wave VR, and basically it's a virtual space for people to enjoy music. And you look at it and you think, is this too early, right? Is this too early? But on the flip side, it could be the future platform for people to consume media, so I'm willing to take that risk. I think the earlier you are and the less data you have to support your proposition, frankly, the bolder it needs to be, right? So, look at how companies like Tesla and SpaceX came about. I mean, these are really, really bold ideas, right? So if you're starting very early with limited data, just make your idea bold. Make the idea bold. Thank you, guys. Much appreciated. Thank you, Ben. Thank you very much.
Thank you, Carlos and Ben. Thank you very much.